Hello and welcome to Trade Finance Talks. I'm Mahika Ravishankar, Deputy Editor at Trade Finance Global. And welcome to our latest series, Banking on the Present with BAFT. In this debut episode, we'll be unpacking what may be the hottest topic in transaction banking, stablecoins. I remember hearing lots about stablecoins around last year's Money 2020 conference in June, although they'd been around for over a decade. Stablecoin supply grew from $5 billion in 2020 to $305 billion in 2025, with the market projected to hit $500 to $750 billion in the coming year. But what does this mean for cross-border payments? What makes a stablecoin special? And down to the fundamentals, what even is a stablecoin? Deepa Sinha, Senior Vice President of Payments at BAFT, and Martin Cannings, Co-Chair of Payments at BAFT, will answer your most pressing questions on the subject. Thank you so much for joining me today, Deepa and Martin.
Thank you.
Please, can you both introduce yourselves and tell us how you're involved with BAFT? Deepa, why don't you start?
Hi, my name is Deepa Sinha. I'm Senior Vice President for Payments and Financial Crimes. I have about 25 years experience in corporate treasury, payments, and financial crimes in global-based roles. And I'm also the BAFT Secretariat and SME for Payments and Financial Crimes committees at BAFT.
Thanks a lot, Deepa. Martin?
So my name is Martin Cannings. I'm a digital asset product manager at Citi. I've been in transaction banking for around 20 years across the payments and the card space. And I also hold the role of co-chair of BAFT Payments Committee as well over the past 18 months or so.
Great to hear, and can't think of two people better suited to our inaugural episode of the series. Deepa, to begin, could you please explain exactly what a stablecoin is for our listeners and why are they so important in the current transaction banking landscape?
A stablecoin is a type of digital asset designed to maintain a stable value relative to its reference asset. So most commonly a fiat currency such as the US dollar. And unlike the volatile cryptocurrencies out there like Bitcoin or Ethereum, and you see what's going on with Bitcoin these past few weeks, stablecoins aim to reduce that price fluctuation by being backed, or you could say algorithmically linked to assets, currency reserves like the USD, as we mentioned. 95% of stablecoins fall into this category. You also have short-term government securities, and you have commodities and other digital assets. From a digital transaction banking perspective, stablecoins do represent programmable digital cash that can move on a blockchain rails with almost near-time settlement, 24/7 availability, and also potential cost efficiency in cross-border corridors. They're very important in today's transaction banking landscape because they're going to address the frictions in cross-border payments. So, speed, cost, cutoff times. They can provide settlement optionality in volatile foreign exchange environments. They do enable programmable settlement logic, so smart contracts, and they offer liquidity management tools for various treasury functions.
So with all of that in mind, what industries would you say are best suited to stablecoin payments?
Not all industries are natural candidates. So the strongest use cases typically share three characteristics, okay? They're going to be high cross-border payment friction. They experience foreign exchange volatility exposure, and they have a need for speed and certainty of settlement. So examples of strong candidates would be global trade and commodity markets. They have documentary trade settlement, they have receivables financing, and they have emerging market corridors that they're trying to get into. Another strong candidate would be remittances, industries that focus on remittances because high fee corridors, migrant worker flows, low value, high frequency transfers. And another example is financial institutions, interbank liquidity transfers. They have significant collateral movement. And then also they are already participating in the settlement of tokenized assets.
Thanks a lot, Deepa. And you touched on this when you mentioned they're tied to different fiat currencies, but can you break down a little bit more what types of stablecoins are actually out there? And maybe what are the most popular ones being used at the moment?
Like I mentioned, you've got the fiat-backed stablecoins, right? They're reserve-backed. They're backed by USD. An example of this is the USD coin, USDC, by Circle. This is probably one of the most widely used stablecoins for cross-border payments and liquidity movement right now. And then how it's relevant to transaction banking, it's that it's fully 100% backed by the USD currency. So you get the assurance that if it's being used in a compliant fashion, it'll be 100% backed by the issuer, and you shouldn't, hopefully, lose your money. There are other types as well, such as crypto collateralized stablecoins and algorithmic stablecoins. But quite honestly, that's for another podcast.
It segues to what I was going to ask Martin next, which is some stablecoin alternatives. Could you please walk us through them, Martin?
Yeah, certainly. So, I think if we compare stable coins with some of the other digital alternatives, we can see then just how stable coins stack up. So regular cryptocurrencies, if we start there, are typically more volatile, speculative assets with a value driven by supply and demand. Stable coins, though, by comparison, are fully reserved. So there's a requirement under most regulatory regimes for digital assets that stable coins are backed by 100% cash or similar high quality and readily available assets. Stablecoins really are designed to take advantage of the benefits of blockchain payments. That is, being 24/7, immediate, programmable, but without the inherent volatility that you have within a pure cryptocurrency, which of course is what makes crypto ineffective as a longer term store of value.
You mentioned that stablecoins are fully reserved. So what's the difference between a central bank digital currency or a CBDC and a stablecoin?
First of all, it makes sense to start with, well, what is central bank money? Because that's the basis of a central bank digital currency. And central bank money is a direct central bank liability, meaning that it's largely considered risk-free. So the main forms of central bank money that you'll be familiar with are the cash that you might have in your purse, or indeed the reserves that commercial banks hold with central banks. Central bank digital currency is generally represented in two varieties: retail and wholesale. Retail CBDC is typically intended for use by consumers, whereas wholesale CBDC might be viewed as a digital form of the reserves that banks maintain with central banks. So it's really just another form of that central bank liability and doesn't carry with it the same requirement to be fully reserved. The other difference, is that stable coins are typically privately issued. And therefore, there is that element of issuer risk, albeit, as Deepa alluded to, it's fair to say that the fact that stable coins are fully backed will give those users comfort in terms of the reserve requirements.
Finally, what about tokenized deposits? Are they both similar, given that they both live on a blockchain?
There certainly are similarities. So tokenized deposits are a digital representation of a traditional bank deposit, but stored then typically on a blockchain. That means that it's a liability of a regulated commercial bank. And similar to stablecoins, a tokenized deposit is going to provide a stable form of value on chain. And the advantage of a tokenized deposit, it's typically going to be treated as a regular deposit by regulation, and therefore it can operate within existing banking regulations. Tokenized deposits enable banks to continue their role of taking deposits and making loans, and by extension, driving economic activity. On the customer side, through the use of tokenized deposits, they'll continue to benefit from deposit insurance for the most part that might apply in a market. So just as a regular bank deposit would. The challenge, if I could move to that, for banks and for tokenized deposits is one of interoperability. So most of the activity that's been conducted on tokenized deposits to date has been proprietary and within single institutions. And the question really is, how do you ensure that banks are going to be able to interoperate and exchange value as they do today in the financial marketplace? And there's a couple of options there. On the one hand, there is some work that banks have underway looking at bilateral arrangements, which is a great way to settle on chain, but perhaps is not fully scalable. So if we look more broadly at the industry, there have been some really interesting industry-wide initiatives that show real promise. And I'll give you two quick examples. One, in the UK, the Tokenized Sterling Deposit Project, formerly the Regulated Liability Network, is developing an environment that supports tokenized central bank money, tokenized commercial bank money in the same place. So the project group there expect to conduct live transactions later this year, and the reports, the findings will be published after that. Secondly, if we look at this at an international level, the Bank for International Settlements is sponsoring Project Agora. And Project Agora is a global initiative involving 7 major central banks, including the ECB, the Bank of England, and the Federal Reserve Innovation Center, as well as more than 40 commercial banks and other payment companies. And it's seeking to basically prove how tokenized sovereign money can fundamentally up-tier the way that banking operates today for payments. And that's focused on wholesale cross-border transactions. The results from this experiment are expected to be published in the first half of the year. And with that, expect to see a report on the technology that's involved, a legal analysis of how the platform would operate, and also then business insights into how the solution might address the challenges that we see today in cross-border payments.
I'm really excited for the results of Project Agora. I think the banks involved, I believe, go from like Japan and Korea to Mexico and then have the European ones in the middle. And I've always thought that Agora was such an apt word for it, given the Greek meaning. Deepa, kind of building on what Martin has been discussing, can you tell us a bit about the regulatory and legal status of stablecoins around the world?
Sure. And there's a lot going on in this area, so bear with me here. Across major jurisdictions, stablecoins are increasingly being treated as, payment instruments, stored value, or e-money equivalents, or even a new category of regulated digital settlement asset. Based on that, regulators are focused on 3 systemic concerns: the run risk, which is redemption pressure; reserve transparency; financial stability and monetary sovereignty; and then, of course, financial crime controls. If you look at the European Union, they've passed some regulation called MiCA around crypto assets, and they probably have the most comprehensive stablecoins regime right now. MiCA's created 2 categories: asset reference tokens, ARTs, e-money tokens, EMTs, and most of the fiat-backed stablecoins fall in the EMT category. Some of the requirements that they looked at when they're regulating any kind of stablecoin, obviously you have to have authorization from a national regulator. There has to be one-to-one reserve backing. The assets have to be segregated separately from the fiat currency, and redemption has to be at par. So the capital requirements and the governance and the white papers and all that stuff that go along with this are basically supporting these key requirements. And then, of course, all of this translates to enhanced oversight. They're going to be fully looking at that. But if you look at the status of it, it's been fully adopted. Implementation has been rolling out, since 2024, and its impact has been pretty clear. It provides regulatory certainty, it favors fully reserved fiat-backed models, and it just gives the assurance of safety in terms of stablecoins. Now, if we jump to the US doesn't have, not yet, finalized federal stablecoins law, but the regulatory direction is fairly clear in the Genius Act that was passed. So if we look at that, the current framework, stablecoin issuers typically operate under stable money transmitter licenses. So they have to have licenses. And then they also have to have trust charters. They have the same AML obligations under FinCEN and possibly even more. And potential SEC and CFTC scrutiny is depending on the structure of the stablecoin and of the issuer. If you look at some of the recent legislative proposals regarding stablecoins and what their requirements are, it's again one-to-one reserve backing, federal and or state prudential supervision, regular reserve attestation, so making sure that you do actually have reserves backing up that stablecoin, and very clear redemption and settlement rights. The direction that the regulatory landscape is taking in the US is that stablecoins are increasingly treated as payment instruments when they're properly structured. And that's the key point. Debate, however, on it is whether only banks should issue stablecoins or whether NBFIs, non-banking financial institutions, may also continue issuing them under supervised regimes.
Following the passing of the Genius Act last July, would you say that there's been a global trend towards passing some kind of or progressing domestic legislative stablecoin frameworks around the world?
I would say so, because I feel like Europe, UK and the US pretty much are leading this charge, and other jurisdictions are looking to them for guidance. I'm not belittling Asia. I'm not belittling any other region. That's the trend that I've seen. That's from, maybe my American eyes. I don't know, but I've seen definitely, if you look at what Europe did and now what the US has done, what the UK is doing, and then you look at some of the things that are happening in Asia Pac and the Middle East, that's the way the trend is going. The end goal doesn't matter who got there first. The end goal is that the regulatory framework be harmonized across regions so that there is interoperability and that the regulatory requirements are fairly, I'm going to use that word again, fairly in harmony and meet the requirements of each of the jurisdictions and keep the environment safe from money laundering and scams and whatnot. So if I go into the UK, if I look at what the UK is doing, they're integrating stablecoins into its financial services regulatory perimeter. They've proposed reforms around that certain stablecoins be recognized as actual regulated payment instruments. So this is huge. The issuers will actually fall under the FSA oversight, the Financial Conduct Authority oversight. And then the Bank of England will provide oversight for systemic stablecoins. Their focus areas are fairly the same: operational resilience, redemption guarantees, and custody standards. And it's very similar to MiCA, but they do have their own existing payments law. So some of it's going to be tailored around that. If we go further east into Asia Pac, China actually prohibits cryptocurrency trading. They have no legal framework for permitting private stablecoins. Instead, they're promoting their own CBDC, which is the ECNY. So stablecoin is effectively banned in China. But in Singapore, under the MAS, the Monetary Authority of Singapore, they have to be pegged to a single currency. They have to maintain the reserves. It's the same requirements: provide timely redemption, meet capital and disclosure standards. They have to have the reserves held in a trust. Their model is like the US and the UK, is very pragmatic and innovation friendly, but prudentially strict to make sure that nothing happens. If you look at Hong Kong, it's the same thing: full reserve backing, mandatory licensing for proper management, AML, CFT compliance, and reserve backing. Japan, same thing. There has to be, issuers have to be trust companies, banks, they have to be licensed. And it's the same type of requirements of full reserve backing, licensing, AML, CFT compliance.
Hey, enjoying the episode? Tap follow for more. Done? Let's get back to it.
Back to an earlier point you just mentioned, would you say the UK's framework is innovation friendly? Because typically, in terms of financial and payment regulation, it tends to align more with the EU's legislative style of being, pretty stringent.
I feel like stablecoins are so new everywhere that innovation is going to happen. And the jurisdictions, whether it be the US, the UK, the Europe, Asia Pac, Middle East, wherever it is, or even LATAM, it's inevitable that there's going to be innovation around stablecoins. I think this is just the beginning. I don't think that we've reached the end stage of what a stablecoin is. As its uses grow, new innovations around it are going to come about as well. So I don't think any jurisdiction can help. They have to be innovative, and they have to allow for an innovative environment in order to keep up and to grow and bring about, basically evolve this new technology.
Thank you. Just final question on this point of the status of stablecoins around the world. In the global push for de-dollarization, which people will argue is at different stages of progress, would it help other regions around the world to accelerate national or regional currencies denominated stablecoin regulation? And what's the association between global adoption and doubt in the US dollar as a safe haven currency, maybe?
Okay, so for your first question, tell me if I'm wrong on this. Would accelerating non-USD stablecoin regulation help de-dollarization? It can help at the margin, but I don't think it's a silver bullet. It can create credible local currency rails on-chain, which is obviously a prerequisite for any kind of meaningful adoption by banks, PSBs, any corporates, or any treasurers out there. What it can't do is overcome network effects. So USD stablecoins dominate because the deepest pool of liquidity, trading pairs, and settlement corridors are all USD based. And it cannot replace the macro drivers of the dollar use: invoicing of commodities, safe haven behavior and stress, the depth of the US capital markets. It's the actual plumbing of the correspondent banking arena, right? Local currency stablecoin regulation is necessary for de-dollarization, but it's not sufficient.
Fine.
I was going to answer your second question.
Yes.
The association between stablecoin adoption and doubts about the dollar as a safe haven. In the data and policy literature, the stronger association is actually the opposite of what many people assume. Stablecoins are overwhelmingly USD referenced, and that structure tends to extend the dollar's functional footprint into an on-chain settlement rather than reduce it. The BIS explicitly notes that stablecoins are designed to maintain value relative to fiat currencies, which is overwhelmingly the US dollar.
Thanks a lot for that, Deepa. Martin, I want to come back to something you were saying a little bit earlier. A challenge in tokenized deposits surrounds interoperability. What are the challenges and risks in using stablecoins for cross-border payments, and how would you respond to skeptics?
I think we are very early innings with the evolution of stablecoins. It is true they are predominantly US dollar issued today. The use cases really are focused within the crypto ecosystem. 10, 11 years ago, when the stablecoin concept was born, it was driven by a need to find a stable value on chain to purchase Bitcoin. And it's really evolved from there. It's interesting that the majority of use of stablecoins remains in that domain, some 90% or so. The growth, though, will need to come from other directions, whether that is in the e-commerce space, potentially remittances, where stablecoins has made significant inroads into true market share, particularly for territories that perhaps have more volatile currencies. Returning to the question of where the challenges are with using stablecoins then for cross-border payments and, if you like, for real world transactions, I think there's a few to cover. So first, there's the challenge of regulatory fragmentation. There has been an incredible amount of change really over the course of the last 18 to 24 months with the emergence of new regulatory codes for digital assets, but there is still a journey there, not least on the harmonization of those different regulatory codes for cross-border transactions. On the cost side, it's important to be sensitive to not just the headline cost of stablecoins, which may be, markedly cheaper than traditional payments, but actually the true end-to-end cost, including any conversion into and out of the stablecoin. And that also links to the challenge of interoperability. As we see more stablecoins emerge and be launched, as stablecoins grow in popularity, there remains that challenge of how those stablecoins might interoperate with one another, not least where there are differences in blockchains, token standards, messaging layers, and so on.
Could you elaborate on the true end-to-end cost of including conversions in stablecoin transactions?
Yeah, I think that's really just the point. There are times where transactions are moving into and out of stablecoins, but perhaps require conversion then back into fiat at the end of the transaction in order for that value then to be used on an onward basis. As stablecoins perhaps become more widespread and are increasingly held by users rather than used purely to execute payment, that problem starts to dissipate. But I think for the time being, that remains a relatively common problem. There are a few other points. Let me just perhaps focus on two. So there are some novel challenges which will come up for users of stablecoins, particularly where that user is perhaps within an institution. The risk of hacks is something that requires monitoring and perhaps different oversight than is in place today. Operationally on chain, there might be network congestion or throughput limits that users need to be aware of. And as a corporate user, it's important to understand how transactions could be fed into treasury management systems. So that might be connectivity that needs to be built as well. The final point I'd make is that in the compliance space, so for AML and sanctions monitoring, there's really a very different paradigm in place within an on-chain environment. So on the one hand, the visibility of transactions significantly increases. That is in of itself a very positive thing. But it's also true that value can be moved around on-chain incredibly quickly and repeatedly. And that can create additional challenges in gaining clarity on the provenance of a transaction. I think that's something that is going to develop over time, and that the requirements will become clear as we gain more experience.
Thanks a lot, Martin. For those who find these challenges kind of insurmountable, how would you respond?
I think the challenges that I've outlined there associated with stablecoin use they're essentially emerging, and stablecoins are an option, a new rail which can be used to execute payments. And I think it's fair to say that stablecoins are likely to be certainly more suitable for certain types of transactions than for others. So there will be a use case applicability that is going to be relevant here as well. I don't think that we need to force find solutions to all of these problems, but rather identify where stablecoins can be used most valuably.
Thanks a lot, Martin. Deepa, from your perspective at BAFT, has the growing proliferation of stablecoins resulted in more bank fintech partnerships? Or have there been any new and unexpected sources of tension from these developments, if that's something you're willing to comment on?
So has the proliferation of stablecoins led to more bank and fintech partnerships? Yes, but selectively, and of course with guardrails. From the vantage point of the global transaction banks within BAFT's membership, stablecoins have not triggered wholesale disintermediation, for lack of a better word. Instead, I feel that they have accelerated collaboration, targeted collaboration between the banks and fintechs in very specific areas. And one would be on-off ramp infrastructure, of course, cross-border settlement innovation. Then there's tokenization and digital asset platforms. So yes, there has been measurable partnership activity, particularly where stablecoins complement rather than replace banking functions. But have these stablecoins created, I think you said, new or unexpected tensions? There's going to be deposit disintermediation concerns. So banks are cautious. There's also the compliance and risk allocation. So who's doing the KYC? And if there's a problem, who's left holding the bag? Banks operate under very strict BSA, AML, and sanctions obligations. Are the fintech partners, are they subject to the same, or are they subject to different supervisory regimes? So that uneven regulations in the payments industry, a paper that we released a couple of years ago, is coming back. It's still not perfectly level. Because of that, there's the regulatory fragmentation. A lot of the stablecoins issuers, they operate under money transmitter frameworks rather than what the banks operate under. They have trust charters. They have very specific crypto regimes coming about. Whereas banks are subject to the Basel capital rules, the LCRs and liquidity coverage ratios, and of course, prudential supervision. So it's still very uneven. And then there's the competitive signaling versus collaboration. This is where the strategic tension comes into play. The stablecoins were originally framed in some circles as replacing correspondent banking. I've heard this myself. Naturally is going to create some early defensiveness in the banks. But the good news is that the market is maturing. More practical framing now reads as, hey, stablecoins are an alternative settlement rail. They're integrated into the bank-led infrastructure, or they're complemented by tokenized deposits. So I feel like the tone has shifted from confrontation to conditional cooperation. The two things that have surprised us in the market the most are, I'm going to say, stablecoins are reinforcing dollar dominance. There is institutionalization of the stablecoin space. And from a BAF level perspective in transaction banking, their stablecoins are nearly purely disruptive nor purely collaborative. They're a settlement innovation, a type of liquidity instrument. They do propose a compliance challenge. And the biggest question is strategic positioning. So the institutions that are going to succeed are going to be able to overcome these.
Thanks, Deepa. I like that point. It was quite nuanced on neither being purely disruptive nor purely collaborative. I think it's a good way to approach it, just operating in that grey area and dealing with the risks as they come. Just to close off the whole discussion, Martin, do you see stablecoins as an intrinsic part of the future of global payments, or are they all bark and no bite?
I think for sure there is a role. And actually, stablecoins really are part of a broader tokenization trend. And that tokenization represents a major shift in the way that we can think about payments and about financial transactions. Now, through this fundamental shift, assets and value can be digitally represented and transferred in a much more fluid way. And it opens up what are essentially incredible opportunities for efficiency, transparency, and more broadly, innovation across the entire financial system. I think just to close this out, whilst stablecoins are part of this trend, I would say stablecoins are something that are likely here to stay and represent a new option to drive more efficient payments. The key thing really, I think, looking forward is that integrating digital asset technologies like stablecoins with established rails and ensuring that interoperability is going to be the key to success.
Thanks a lot, Martin. I'm sure it's not going to be long until I'm paying for my dinner with stablecoins. But Deepa, Martin, thank you very much for joining me today. Really learned a lot and we've covered a huge amount of ground. So I appreciate your time.
Thank you so much for having us.
Yeah, thank you.